Hey everybody, welcome to Unfoolish Investing. I am one of your hosts, Victor, with my friend,
Larry.
and we are going to go take you through our investing journey over the next year, plus how we got here, and what brought us to this point. Today, for episode one, we're going to kind of start out with the basics to unfoolish investing and what three stocks you should start out with. And then we're going to talk a little bit about CrowdStrike, what's going on over there. Seems to be a button subject, hot button topic right now, especially over the last month, and kind of go from there. So with that, Larry, VOO, annual returns over the last 5 years. 2019, we're looking at 31%. 2020, we're looking at roughly 18%. 2021, we're looking at 28%. 2022, we're looking at negative 18%, Larry. Negative 18%. And then 2023, we erased all of that and we went up 21%. What is it about VOO that makes it such a key index to hold in anyone's portfolio?
VOO obviously, it mirrors the S&P 500, basically tracks the entire 500 index. I think the thing that's helped it so much over the past, say, 18 months is the heavy tech cap that it has. So as these mega cap tech stocks have kind of exploded after the 2022, call it downturn, not really, but call it a downturn. I feel like Nvidia's carried a huge amount of the S&P returns since then, along with some of the other cap stocks. Meta has had a huge rebound from their lows, 21, 22. One of the great things is for newer investors, VOO's nothing is no risk when you're investing, but it's relatively low risk because you're not getting the outsized ups and downs of investing in any single stock. So it's probably a great first step for people new to investing, just to kind of set it and forget it.
I agree. And personally, I drip into VOO on a weekly basis. For anybody that's not familiar, basically you just buy in fractional shares as little as $5 for new investors. Because some people say that they don't have that money to invest. One cup
Yep.
of coffee going in every week,
Mm-hmm.
you'll start accruing and you'll start earning a lot better interest on that money by putting it into that. But I couldn't agree more. I think that between Nvidia, Microsoft, the S&P 500 to me is the staple. And
Yep.
if you're going to start off investing, any investor should seriously look at VOO as one of their core staples. And moving on, once you get VOO going, I always tell people you got to set up QQQ. That is essentially doing the same thing for the Nasdaq that it
Yep.
does for the S&P 500. And just run through the numbers pretty quickly. Over in 2019, QQQ did 39%. 39%, a little bit higher than 39%, but we'll just round numbers to make it easy. 39% in 2019. 2020, 48%. Absolute beast. Beast in 2020. Like the entire world is like starting to collapse, and the QQQ is going through the roof. 2021, 27.5%. Again, I am not seeing any negatives until I hit 2022. But as you see where S&P 500 went down 18% in 2022, the Nasdaq went down 33%, which would have scared a lot of people. And Warren Buffett, everybody's favorite investor, always said, be greedy when others are fearful. This is when I think a lot of investors that have been doing this for the long term started putting down more money, because there's nothing a long-term investor loves more than a heavy sell-off. And that's what we saw in 2022 when it dropped 33%. But again, bringing it back to 2023, 39%, Larry. 39%. Insane. Everything that we lost in 2022, we got back in less than 12 months, plus 6 more percent. So it was like, yes, it went down, but every great investor knows that the market goes up and down, but it always goes up far more. It always goes up far more. It drops 33% one year, and it's back up 39 the following. How do you feel about QQQ?
I mean, QQQ is probably one of my best performing holdings. It's one of the things I've held the longest, so time certainly helps. I think, to your point, once you get VOO set up, I think especially if you're on the younger side, QQQ, you're probably going to want to put some into that because you can get outsized returns for longer. You'll have time to compound over a longer period of time, and you can tolerate a little more risk at a younger age. Whereas if you're a little bit older, VOO is definitely more safer than QQQ. But if you can tolerate the risk of, the Nasdaq, you can reap the rewards over the long term. So I love it personally.
What year, can I just ask for everyone out there, what year did you start investing in QQQ?
15.
Wow, okay. So you've gotten
Yep.
almost 10 years, and would you be open to sharing over the span of almost 10 years what your returns were?
I think it's a little over 200% returns. It's not something that I've dripped into all the time. So it's just a couple of spot buys over that long period. So I think if I had dripped into it the whole time, my return would be a little less. But I would have more skin in the game in that particular index.
Yeah, no, I mean, I totally see where you're coming from, and just so everybody understands, you're looking at, with the QQQ, roughly close to 20% returns annually over a long span of time. Because what you do is you end up erasing those negative years with monster years. So although 2022, you lost 33% of your portfolio in that one index that year, in 2020 it went up 48%. So you still haven't even erased that 1 year worth, and then the following year goes up 39%. So again, the longer the term you invest, the greater the benefit in your return. And the compounding over time, I mean, that's how people make 10,000, 50,000, hundreds of thousands. That's how millionaires are made. It's not by short-term investing, day trading. It's that long-term compounded interest. Now the third quote-unquote index, but it is in fact a stock that we believe that every person who invests should own, and that's Berkshire Hathaway's B shares. It's in 2019, it did 10.9%. 2020, it only did 2%, maybe 2.5%. 21, it did almost 30%. 2022 did 4%. 2023, it did almost 16%. And year to date in 2024, it's 19th a little over 19%. And that's over 5 years. I have owned Berkshire much longer, and my annual returns on Berkshire are probably one of my highest holdings. But my view on Berkshire is this. You have one of the smartest, and rest in peace, Charlie. You have two of the smartest investors ever running a company with some of the smartest individuals in the financial markets today. The people that are in Berkshire that are making the decisions along with Warren are some of the brightest minds in finance and in stock investing. And for me, I'm going to put my money with the people that know what they're doing. And that's far better than paying a financial advisor, a percentage, or even paying a financial advisor a flat amount. Like, to me, investing in VOO, QQQ, and Berkshire B, right? You don't need financial advice. Just those two indexes in one stock will take care of the majority of your investing prior to going out and picking individual stocks. What are your thoughts on Berkshire?
So to your point about the B shares, for people that don't know, there's also an A shares class that you can buy. If you own that, they're over $600,000 a piece as of the time we're filming here. So, if you have that, you're probably not listening to us anyway.
Just because you mentioned the A shares, when
Yeah.
I first started investing in the B shares, I think the A shares were a little over 100,000, and I thought they were insane, and there was no chance they could go any higher at $100,000 a share.
Yeah.
I was wrong. I was so wrong, and now at over 600,000 a share, it just shows you that Berkshire mints money. And they know what they're doing, and long term, you're going to be phenomenal.
Yep. I mean, I haven't owned Berkshire as long as you have. I think the first time I bought Berkshire was actually in 2020, right when the COVID pandemic was really starting to rage and the market was kind of collapsing. I bought Berkshire then. I've dripped into it since then. Even in that short window, it's only about 4 years. I'm over 100% return. I think it's like 120 something percent. So even over that shorter period of time, I've had some pretty good returns with Berkshire. And to your point, it's just about how savvy Warren and Charlie and the rest of the crew have been. Over the years, they've just made some really incredible investments between Bank of America when, in 2008, when, the stock market was collapsing, the real estate crisis, all that. Apple, obviously, it's the biggest holding in the portfolio. It's just created generational wealth for people that have invested in Berkshire. They do sell stocks because lately Warren Buffett, Berkshire, they've been trimming Bank of America pretty much every day for the last couple of weeks. Still owns a huge chunk, but they know how to identify businesses that like you said, mint money. They've owned amazing companies between Apple, Bank of America, American Express, Coca-Cola, Chevron. They've obviously built up their Occidental Petroleum stake, over the last couple of years. But it's just, when you think there might be a ceiling, they find a way to get through the ceiling, it seems. And it does act as a safe haven too. So when the indices are falling, if you go back and look at it, it generally feels like Berkshire falls a little bit less. So it also does act as kind of a safety area to put your money.
It's so true. And I think that, I love that you touched on Chevron because the energy sector is one area that I tend not to invest in individually.
Me too. Yep.
I just don't know enough about it. And Berkshire gives me that exposure to that sector, along with banking. We could talk more about banking another day, but I don't invest in a whole lot of banks. So for me, Berkshire gives me exposure to a variety of different sectors, but it's managed by people that know what they're doing, and I can trust that
Yep.
my money there. And to your point, it does feel like when everything's falling apart, they do fall just a little bit less because they're a lot more, evenly balanced.
Mm-hmm.
So,
Yep. And it works both ways. So like, if the overall indexes are going berserk up, Berkshire might not climb quite as high. So it does work both ways.
it's true. And I think that highlights why anyone that's into unfoolish investing and willing to come down this journey with us, VOO, QQQ, and Berkshire B. Those are the two indexes and one stock that we would say this is where you put your money. If you're unsure of what to do, this is your safe havens. This is where your money will grow long term while you try and figure it out. And this will give you, the most reward without having to pay a financial advisor either a commission, which I'm not a big fan of, or even worse, that dreaded percentage fee that some financial advisors charge for their assistance. You don't need it. VOO, QQQ, Berkshire B. Anything else to add around those three, Larry?
I don't think so. I think you summed it up pretty well. Those are, three great foundational choices to just kind of put your money away. You don't have to think about it every day and just let it grow over time.
Agreed. On that note, I felt like we should pivot over to the hottest topic in the stock market in the last month, and that's CrowdStrike. I'm not sure if everybody's familiar with CrowdStrike, but they are a cybersecurity firm. They are probably the quintessential cybersecurity firm. They recently pushed a patch out to all their users, and if you had Windows, it pretty much crippled and shut down your systems. Delta is now suing them due to this, and over the span of less than 1 month, their stock has gone from a roller coaster up to a 44% roller coaster dip down. Thoughts on CrowdStrike right now?
I have been a long-term investor of CrowdStrike. Even after this downturn, my returns are quite nice. I think over 100% still. I think the reaction to this is a little overblown personally. It's almost like it was a self-inflicted breach, if you will, where it was just like a lack of control that pushed this update out, prematurely. But I think it's been a great company. I think, the Falcon platform is kind of the premier service, in the cybersecurity space. We'll see how the leadership team at CrowdStrike reacts to this. I know the first reaction wasn't well received, where they were giving out Uber Eats gift cards to people that, to companies that, had some sort of an issue with the update. They do have a lot of cash on hand, so if they do get sued and they do need to pay out, they're in a good financial position. to pay out those settlements. I would assume that they have some kind of insurance for this as well. But I don't think this shows an issue with the actual cybersecurity software suite itself. So I would still be buying here. I've been adding over the last week to 10 days. It does just keep going down. I'm kind of adding on the way down. Hopefully we'll get to a bottom soon, but long term, I'm a CrowdStrike bull.
I couldn't agree more. And I mean, I feel like that entire sector, especially CrowdStrike, is very sticky. And I feel like when we talk, we use that term sticky.
Very sticky. Yep.
Yeah, we use that term sticky a lot. And basically, it's that term that you throw out there, like, you don't see people jumping between bank to bank very often because of the amount of
Yep.
work involved. And with CrowdStrike, it's not just endpoint protection that they're doing. They've got threat intelligence, cloud security, IT operations, data protection. Like, they have different modules that companies implement throughout. And maybe you start with the Falcon platform, but now you're adding in more modules. And the amount of, impact that CrowdStrike has on your company by protecting it, it's not something that you can easily unwind and replace with something else. And if you do, you're looking at 9 months to a year plus for any company to even come close to doing that. And I got a quick slide here for you, and what I kind of like look at is, let's see, Chipotle. And everybody's going to be like, why are you comparing CrowdStrike, a cybersecurity firm, right, to the king burrito maker that we all love? Or maybe you don't like it, but I love it. It's because in 2015 and 2016, right, similar to what CrowdStrike just happened with the security patch, Chipotle had an E. coli outbreak, then a norovirus outbreak, back to back. And it sent their stock, as you can see, from 750 area, and it cut it in half. It dropped it down to under threes and the twos, right? 53% of its value lost over the span of roughly 2 years. Now, was the food still not good? No, the food was delicious. Were they not making money? No, they were still cranking. What was the problem? The problem was that they had 2 issues back to back with contamination. And they needed to address those. And the market, as I believe, didn't think that they could fix that, which I believed was just insane, right? Everything that they're doing is running on all cylinders, and it wasn't like every store was having this problem. It was a couple stores here, a few stores there. Wasn't widespread, but it was a problem. And that's where I kind of see CrowdStrike right now. CrowdStrike is falling rapidly. Not because, to your point, they weren't compromised. Nobody was able to hack through their systems. Nobody was able to push virus, ransomware, any sort of malicious content through their, protections, right? They pushed a patch to Windows and Mac. The Macs didn't get it. Mac users over here doing the dance. And it was mainly only Windows machines. And to me, they've already pivoted. For me, they've pivoted because they've already stated that they're going to be doing staggered rollouts of patches in the future to mitigate this. Should have been done from the beginning, but you're learning. That was a great message that I heard from management, right? And they're owning it. They helped everybody back up. For me right now, as you can see with, Chipotle, if you had bought Chipotle when it went into the twos in 2017, end of 2017, the beginning of 2018, right? At the end of the whole problem, I believe the stock just split. Larry, do you remember the price it split at?
I want to say it was a little over 3,000. Let me check.
Can we get confirmation?
One second here.
We just want to make sure we're accurate here. Because I thought it would,
Yeah, so it was a 50-for-1 split.
at close to 3,000,
Yeah. Yep.
right? So had you invested during that outbreak, which again is what unfoolish, savvy investment is about, looking for these buying opportunities, you would have gained 10x on your returns, right? But you
Yep.
have to look at the financials. You have to look at the fundamentals. You have to see past the media and the marketing blitz on the fear and be like, am I still going to Chipotle? Yes. Are all my coworkers still going to Chipotle? Yeah. Okay. Is the food still
Yep.
good? And you kind of go from there. And that's where I kind of look at CrowdStrike right now. We're at a 44%, I believe roughly 44% drop as of
Yep.
the airing of this podcast. You and I have both bought as it's dropped on the way down, and we will continue to buy because for us, these are the key buying opportunities that unfoolish investors need to be looking for. Opportunities where the fundamentals are still strong, but it's something else that's creating the sell-off. And again, I'm not sure why people are selling it off. It could be just super wealthy people taking a little off the top. But as an unfoolish long-term investor, I see this as a savvy opportunity to buy into a company at an extreme discount. And if you look at some perspectives on where CrowdStrike will be, most estimate that CrowdStrike will be over $1,000 a share by the end of 2035. So in a little over 10 years, right, you're looking at almost 10x return, possibly more. So again, if I'm comparing it to Chipotle, right, this is the buying opportunity. This is the buying opportunity that I believe investors need to be looking for. What are your thoughts?
I agree with you almost 100%. I'll be a little bit of a contrarian. I'm going to keep buying it. I've been buying it. It's one of the stocks I drip into. I put money into it every week, automatically. One thing I will be looking for in their next earnings report, which I don't think is for a little bit.
End of August.
If you start seeing revenue go down, to me that could be a sign that they are losing current customers. And that would give me some pause if they're starting to lose some of those legacy customers that, we just talked about how sticky the cybersecurity space is. If companies are so, dismayed by what's going on with CrowdStrike that they take that time to say, you know what, we're going to put a year in and, we're going to decouple and go to a competitor. If enough companies are willing to do that, that would give me some pause to stop buying the stock.
That's fair. I can't argue with any of those points. They're all solid. Being someone that is in data security for a living, and full disclaimer, I am not a financial analyst. These are merely my opinions.
Mm-hmm.
CrowdStrike, what it does that I find is unique compared to what I think its nearest competitor is today, which is Sentinel-1. Sentinel-1 still requires hardware to be on-site or involved in some aspect of what it is you're trying to do. CrowdStrike's able to do what they're doing with no hardware requirements. That basically means thin clients are installed on machines. Pretty much all the work is being done up in the cloud, and you don't have to put any hardware anywhere in your system. And that, to me, mitigates the need for patching, updating, replacing, right? And I think that, to me, is the big difference between their nearest competitors and who they are, is the ease of deployment of their systems and adding their modules in with the need of no hardware, to me, is like a no-brainer from someone that comes from enterprise security.
Okay, that's an interesting perspective, because I'm not, I don't work in that space, so that is good to know.
I will say, I really do appreciate, getting this podcast off the ground today. This is episode 1. The big thing that Larry and I talked about as we were going into this financial journey is that full transparency. That was our big thing, that we wanted to make sure that any company that we were talking about, we were actually investing in. We weren't going to talk about and say, buy this company for this reason and just move on with our lives. The companies we're talking about are companies we're actually putting skin in the game into.
Yep.
And, that to us is the importance of investing and importance of educating and putting this messaging out there, is that you can trust that we're doing what we're talking about. And, I can't say everybody does that, but, we'll save that for a different podcast.
We will.
Okay. Have anything else to say, Larry?
No, I'm excited, and I couldn't agree with you more. One of the main reasons I decided to get into this, exactly what you said, is that, I've been a member of various, investing advisement services, where you're paying for advice, and then the folks that are giving you the advice aren't investing in the stocks that they're telling you to invest in. So how good can they be? Or at least it gives you pause. They're telling me to put my money in something, and I'm paying them to tell me to put money in something, but they're not doing it themselves. So that's one of the things I'm really excited about. What we're trying to do is we're trying to educate people, inform people, and we're going to be taking the steps right with everyone.
Couldn't have been said better myself. With that, again, I'd like to thank everybody for joining us today on episode 1 of Unfoolish Investing, Smart Choices for Savvy Investors. If you like the podcast, feel free to hit subscribe, hit the like button, do them both. See you next time.
Thanks, everyone.
Bye now.